Okay, well, let's get started, and welcome to our webinar today, which is all about residential property tax. Delighted to be joined today by Kathy Martin, Tax Director here at Condé Mathias. Welcome, Kathy, who's going to be doing our presentation today. We're hopefully going to have some time at the end to take any questions that you might have. If you would like to put a question forward to Kathy, be grateful if you use the Q&A option on your Zoom toolbar. That allows you to put your questions forward. We can see them and we can come back and answer them at the end. The webinar is being recorded, so we will make an on-demand version available on the website tomorrow, Saturday. We're on-demand version on the webinar by Monday at the latest, and we will email everybody who's registered for this event with a link to the recording so that you can recap on any points. So at this stage, I will hand over to Kathy and look forward to hearing all about property tax. Over to you, Kathy.
Yeah, thank you, Jo. Welcome, everybody. So as Jo said, I'm Kathy Martin and I'm a tax director here at Condé Mathias. I work with a wide range of landlords and property investors to help them understand the tax implications of their investment plans and find them reliefs and allowances that help them make the most of their property income. So this is what this webinar is all about. Next slide, please, Jo. Over the last 20 years, the number of people holding property as an investor or landlord has increased significantly. And there are a number of reasons for this. Very low rates of interest on deposit accounts, the exponential growth in house prices, historical low rates of interest on mortgages, and the unpredictability of investing in the stock market. This huge increase has led to the government to review its approach to property taxation to balance the needs of regular property purchasers against investors. In response to a number of new challenging property tax rules that have been introduced in recent years, which have limited the amount of tax relief available to landlords and investors and led to additional costs, reducing returns. Despite these challenges, property investors still, in most cases, offer a stronger, more stable return than many other forms of investment. In today's presentation, we will look to cover a wide range of tax issues currently affecting landlords and investors. This will include making tax digital for income tax self-assessment, changes to the capital gains tax rules, property portfolio incorporation, property and inheritance tax planning, furnished holiday lettings, and some other useful reliefs. We will then finish with a quick question and answer so you can let me have any queries that you may have. Next slide, please, Jo. So far, thousands of businesses across the UK have been getting to grips with making tax digital. This requires organisations to record and report tax information digitally each quarter using HMRC compliant software. This is the first stage in HMRC's strategy to digitise the UK tax system and has so far only applied to VAT. That the HMRC was meant to roll out MTD for income tax self-assessment from April 2024, but there have been a significant disagreement with this, and all the professional bodies have been trying to delay them implementing this, and it's worked. It's now been delayed until 2026, and we'll wait to see whether that still goes ahead. We're anticipating it will. So despite this delay, it's important for those affected to make sure they're ready for the change sooner rather than later. So let's discuss who will be affected by these changes. From the new start date, instead of making tax digital for ITSA applying to all self-employed workers and landlords with property and or business income of more than £10,000, it will now only apply to those with income exceeding £50,000. So that's a huge change in HMRC's approach. As per the original plan, they will have to keep digital records and provide quarterly updates on their income and expenditure to HMRC through MTD compliant software. Those with an income between 30 and 50,000 would also need to comply with this from April 2027. However, all taxpayers will be able to join voluntarily beforehand if they wish. Next slide, please, Jo. So what do you need to submit? If this change affects you, you will need to complete 4 quarterly submissions plus an annual return digitally. According to the latest information from HMRC, taxpayers within the scope of MTD for ITSA must keep digital records of each transaction, including details of which category each of their transactions falls within and the total amount of income in each category. These categories are themselves separated into 2 types of income for unincorporated businesses. The first is businesses with trading profits, and the second is businesses with property income. A full breakdown of the various categories that will need to be recorded in these quarterly returns can be found in the HMRC notice published in July 2022, and that can be found on the government website. Incidentally, if you want the link, let me know, and I can email that to you afterwards. These new requirements are much more onerous than the current self-assessment system, and so you must prepare as soon as possible for this change. Some taxpayers may also be required to submit additional information at the end of each quarter. This end of period information will have to be provided in an end of period statement and will depend on the relevant person's business or businesses. Within this statement, a relevant person must provide the totals of the amounts falling within the applicable categories of transactions, the additional information set out in the end of period notice. The relevant person must identify and remove any disallowable expenditure before providing the report total for the relevant period. Further clarification and guidance on the submission expectations for Making Tax Digital may still be published, and so taxpayers must keep abreast of the latest changes. So let's look at what happens if you fail to submit on time. The government has announced a more favourable system of penalties for late filing of tax reports for Making Tax Digital. From January 2023, HMRC has introduced a new points-based MTD penalty system, which replaces the previous late submission penalty regime. Under the new system, for each submission deadline that is missed, you will accrue a single point. Once you receive a certain number of points for late submission, you will then receive a fine. This more progressive approach to penalties will vary depending on how frequently you are required to report. For example, for annual submissions, accruing 2 points will result in a penalty. In case of quarterly reports, such as MTD for ITSA, 4 points will result in a penalty. If you are required to make more regular monthly submissions, 5 penalty points will end in a fine. The standard fine for each of these submission penalty thresholds is an automatic £200 penalty. However, every single late submission after this initial fine will result in an additional penalty being added. Although points are accrued over time, they will also expire after 2 years when a taxpayer demonstrates ongoing compliance with the rules. The 2 years are counted from the month after you received the penalty point. However, points will not expire when the penalty threshold is reached. So although you won't face automatic fines for late submission under this system, the potential for a larger overall fine for extended or regular periods of non-compliance is greater. So what about HMRC compatible software? HMRC has also confirmed that, similar to MTD for VAT, those affected by these changes must use functional compatible software from the point of transaction through to the submissions made to HMRC to maintain digital links. Businesses must use the correct software to meet the new requirements, such as HMRC approved cloud accounting software, or a set of compatible software programs that can connect to HMRC systems via its application programming interface. So the software must be able to do a number of things. It must be able to keep records in a digital format, preserve digital records in a digital format, create a tax return from the digital records held in functional compatible software, and provide HMRC with this information digitally. It must also provide HMRC with tax data voluntarily, and receive information from HMRC via the platform that demonstrates the business or taxpayer has complied. You should take steps now to prepare for this huge shift in taxation. It's going to be quite difficult for most people, I think, to take this on board, but the sooner you do it, hopefully the better it will be for you and easier to understand. We are already supporting hundreds of businesses with Making Tax Digital and can offer dedicated advice on cloud accounting systems that are compliant with MTD and meet your requirements. So please, if you have any questions, let me know in the Q&A. Next slide, please, Jo. So capital gains tax applies to gains that you make when you dispose of an asset. This will include not just selling, but if you're gifting away assets, transferring ownership, swapping, or receiving compensation. Next slide, please. With the rates of capital gains tax changing, they're higher for landlords looking to dispose of residential property. And there are further changes that in April that could have a big impact on their plans. The Chancellor, Jeremy Hunt, announced during the autumn statement that the individual annual tax-free exemption for capital gains tax will be reduced from £12,300 where it is currently to £6,000 in April 2023 and further reduced to £3,000 in April 2024. Landlords are also subject to capital gains tax on any gain generated from the sale of buy-to-let properties, and a rate of 28% for higher or decimal rate taxpayers and 18% for basic rate taxpayers will apply. With the reduction to the capital gains tax annual exemptions applying from April 2023, this means that landlords will face increased liabilities when selling properties in the years ahead. If house prices increase, this means greater gains and larger tax bills on the horizon for landlords and investors who are looking to sell. If you are looking to sell and make use of the current £12,300 annual exemption for the sale, then this would need to be contracts would need to be exchanged prior to the 5th of April 2023 at the latest. So if you haven't already done that, I suspect time is running out for you to take advantage of that. Next slide, please, Jo. If you are looking to sell, be aware that you must report the sale of a residential property situated in the UK to HMRC and pay any capital gains tax due within the 60 days of completion. If a return is not filed within the 60 days time limit, then an automatic late filing penalty of £100 will apply. If the return is more than 3 months late, daily penalties can apply, and then fixed £300 penalties at 6 months and 9 months intervals. Underpayments and late payments of the capital gains tax will also attract interest charges, and the interest will be charged on any capital gains tax which is not paid within the 60-day deadline. Next slide, please. So in recent years, changes to taxation for the buy-to-let sector has prompted many landlords to consider a change of business structure. Incorporating your property business and portfolio into a limited company has many advantages, and it's a route that a significant number of residential landlords have already taken. The benefits can include full relief available for mortgage and finance costs, whereas now they're restricted for individuals. You can gift shares within your annual exemption to each year to individuals. You can draw dividends from the limited company at a lower rate of income tax than normal income. You can make sure that the share classes are different, which will allow individuals to take different levels of income each tax year. You can pay tax on income and profits at the corporation tax rate at a much more efficient level, currently 19%, but rising up to a maximum of 25% from April this year. And you only pay personal tax on income taken from the company. Next slide, please. But there are also potential pitfalls for the unwary, so it's important to get the right advice to avoid costly errors. So potentially there could be large capital gains tax on the sale or transfer of property to the company. So that needs to be looked at in a lot of detail. There could also be stamp duty land tax for the company on the purchase of the property portfolio, and possible annual tax on envelope dwellings with the property in the company if it exceeds a certain value. Next slide, please. No one wants their beneficiaries to have to pay tax on the assets and wealth that they inherit, but increasingly many families are having to settle IHT liabilities at a difficult time in their life. So if you own a portfolio of properties, the likelihood is that you will exceed the current IHT allowances available to you. If you die without making specific plans to mitigate the impact of IHT, your estate will be subject to the full rate, which is currently 40%, on any assets above the nil rate band, which is currently 325,000. While your main residence benefits from the additional 175,000 residential nil rate band, if it is passed to direct descendants, additional homes will not benefit from this relief. Commercial properties in your possession may also benefit from business property relief, but residential ones do not. And so this relief cannot be claimed on shares in a company with investment properties. So if you plan ahead, you can pass on properties or shares in a company to beneficiaries inheritance tax-free as long as you survive for 7 complete years from the date of any gift. However, you will still be charged capital gains tax on any gains, and your beneficiaries will need to pay stamp duty land tax on the acquisition of the property, even where it is transferred to them by way of a gift. Next slide, please. So we'll now touch on furnished holiday lettings and the rules there. If you let properties that qualify as a furnished holiday letting, you can claim capital gains tax release as for traders. So things like business asset rollover relief, relief for gifts of business assets, and relief for loans to traders. You're also entitled to claim plant and machinery capital allowances, whereas you can't on ordinary residential properties. And your profits will count as earnings for pension purposes, so will enable you to make pension contributions if you want to. So let's look at the rules for how properties can qualify as a furnished holiday letting. So the property itself must be in the UK or in the European Economic Area. So that will also include Iceland, Liechtenstein, and Norway. And for it to be classed as furnished, there must be sufficient furniture provided for normal occupation, and anybody visiting there must be entitled to use the furniture. So you must be able to move in and use it as if you know, somebody could actually live there effectively. It can't just be bare minimum, a bed and nothing else. The property must be commercially let, so you must intend to make a profit from it. If you do let the property out of season to cover costs, but did not make a profit, then that will still be treated as a commercial letting. And the property must also meet all 3 occupancy conditions, which are as follows. The pattern of occupancy condition, which means that the total of long-term lets, i.e. a letting of over 31 days in length, cannot exceed 155 days, then your furnished holiday letting will meet the criteria set out by HMRC. The availability condition. So the holiday let must be available for at least 210 days in a year tax year to qualify. You are not allowed to count days where you or your family, sorry, your friends or family stay there in the property within those 210 days. And the last condition is the letting condition. So as well as the availability condition, an investor must also have their holiday let for at least 105 days per year for it to qualify. And those 105 days, again, must exclude any longer lets of 31 days or more, unless there are exceptional circumstances why they were exceeded. Next slide, please. So there are a wide range of other reliefs available to landlords under certain conditions. These include, but are not limited to, the property allowance. So that's £1,000 of relief, which is available to individuals who receive property income each year. That's not in addition to any costs they incur, that's instead of. So if somebody has costs of only, say, £200 in a tax year, then they can instead claim the £1,000 allowance and not the cost itself, which would be more beneficial from a tax point of view. So allowable expenses. So as long as the expense are solely for the purpose of renting out the property, then they are allowed to be deducted for income tax purposes when calculating your taxable profit. There is a replacement relief. So the replacement of any capital item and the cost of a modern equivalent. If the new item improves the old one, then we can just use the replacement cost. And finally, rent-a-room. So this is a scheme which allows resident landlords who are living in a property and they have, for instance, a lodger. They can have the rental income of £7,500 a year without having to pay any tax on that, but it has to be in their main home. So I think that's probably the end of what I've got to say. I'll just have a look and see if we have any questions. No questions. Okay, so my email address, I think, is on here somewhere. If anybody does have any questions afterwards, then please feel free to email me and I will endeavour to get back to you as soon as possible. Thank you.